Welcome to another video for reporting and managing inventory. Today we're talking about the application of concepts, especially cost of sales, income statement, inventory turnover, gross profit margin, and net profit margin. So this particular exercise 12.9 from Cambridge VCE Accounting 3rd edition, Units 1 and 2. That's going to be a focus for this video. Now we've got this owner operator of this business called Antique Arts, an art dealership that is in Munipons. Inventory is recorded using perpetual system, valued using FIFO. If you haven't seen that video already on the application of concepts from chapter 11, which is specific to inventory cards and FIFO and IC, which is the identified cost method, then please pause this one and go and have a look at it first. So we have this information here about credit sales, cost of sales, inventory at the beginning and at the end. This is definitely going to be important when we come to the point of calculating the average inventory. Now what we're going to have is a couple of questions like we always have after a bit of information given to us, as well as we have so this is quite a long question. It's giving us a context of antiques versus previous shop that the owner had, which was a fruit shop, which consistently generated an inventory turnover of 6.2 days. And Mario has been quite disappointed with the inventory turnover of Antique Arts, which was 165 days for the year ended 30 June 2024. Now, please remember, they're two different businesses altogether. It's a fruit shop versus antiques. Now, remember, fruits, perishable items, cheaper goods will be sold relatively quickly versus antiques, which are quite expensive. And if they're expensive, it's probably going to take a bit longer to sell them. Okay, so there's that difference in the nature of the goods that is being sold itself. Okay, so I've done a bit of calculations for you so that we don't have to write them down like immediately when we are doing the question, but rather focus on explaining how it's been done. So with part A, we're calculating the inventory turnover. Now remember this piece of information here, average inventory. Let's move on to the next slide and see what we have for ourselves. Okay, so like I said before, average inventory, we have the information given to us in the question, which is the inventory at the end and at the beginning, which we need for calculating average inventory first, which is inventory at the start and at the end divided by 2. So you get 7,600 here. And the formula for inventory turnover, which we've got written there, average inventory into 365 divided by the cost of sales. And when we do that, again, cost of sales, all of that is given to us. So when we use that bit of information, we are able to easily calculate the inventory turnover, which is 146 days. The second part was referring to this answer in part A. Say 2 reasons why Mario should not be disappointed when looking at the inventory turnover for the year ended 30th June 2025. So look, the information in the question tells us that last year inventory turnover of Antique Arts was 165 days and now it's 146. So it's actually improved. It's 19 days quicker. That improvement in itself should be an indication for we should not be disappointed because there's an improvement that can be visibly seen. It's much more quicker than last year. Second reason, like we discussed before, the two different nature of goods that you're comparing. Okay, so you can't be comparing apples to oranges because that's what's happening here. In terms of the nature of antiques, it's expensive. Okay, it's not as cheap as fruit or not perishable like fruit. So it's not something that will be sold relatively quickly. So now with part C, we're talking about the percentage markup that Mario has applied to his inventory. So the formula for that I've written right here on the screen. So selling price divided by cost price and minus 1. So we've got the 47,500, and then you have got the 19,000, which is the cost of sales, and then we've got the -1 there. Once we do the calculation, it brings us to 1.5 at the end, and to get it into a markup format, we multiply it by 100, and that gives us 150%. Remember, in this scenario, all of that information is given to us, so there is nothing assumed or to be calculated. You've been given credit sales in the information at the beginning of the question, 47,500, and you're also given the cost of sales. And then part D asks, explain how the decreasing percentage markup may affect one, inventory turnover. So the first one, it could actually, if we have a decreasing percentage markup, that could assist or improve inventory turnover, because cheaper goods will increase quantity of sales, leading to an increase in the cost of sales. Then the other one is gross profit. So if this depends on like how big a shift or the change is in the volume of sales versus the decrease in markup. So if the increase in volume of sales is more than the decrease in markup, then gross profit could increase. But if it's the other way around, so if it's vice versa, then gross profit could decrease. And then we've got more information given for August 2025, and then additional information in the question about physical count and drawings, etc. And then you've got the other requirements. So starting part E, you've got calculate the cost of sales for August 2025. Here that would involve cost price is equal to selling price multiplied by 1 plus percentage markup. Now please remember, this we're calculating from the information given to us for August 2025, where you have sales 38,500, sales return 1,500, which gives us 37,000 divided by 1 plus 1.5, which is our percentage markup. And that gives us cost of sales 14,800. Okay, so next part here, part F says we need to prepare an income statement for Antique Arts for August 2025. So from the information we've got, I've put in here our revenue section, which is the sales less sales return, equaling the net sales, 37,000, less cost of goods sold. So the cost of sales, we've got the 14,800. Next, you get the gross profit, and you add to that the inventory gain, which is 400. Again, remember, all this additional information is given to you. Like for instance, for the inventory gain part, you've been given a dot point which says on 31st of August 2025, physical count revealed 6,500 inventory on hand, while the inventory card showed inventory as 6,100. So hence why the 400 came. That gives us our adjusted gross profit, 22,600, less the other expenses. Here we've got cartage out, wages, packaging expenses, advertising, equaling the total of 7,250, and that gives us our net profit. Moving on, next part asks us to prepare the owner's equity section. Now this is only an extract because we're not making the whole statement. So we've got capital of 18,700, add to it the net profit made, which you got on the previous slide, 15,350. That equals 34,050, but you still have to subtract the drawings from it, which is the 2,000, and that gives us the owner's equity at 32,050. Okay, so part H asks us whether there would have been an impact on the owner's equity if Mario had failed to record the withdrawal of the lamp, and if so, what would have been the effect. Now, overall, there would have been no impact or no effect on owner's equity. Why? Because even if we had failed to record this drawing, in the next physical count, it would have just been picked up as inventory loss, which is an expense. Thus, it will decrease net profit, and in turn, it will decrease owner's equity. Therefore, it will have exactly the same effect. Part I says, except for establishing the minimum and maximum levels of inventory, explain one inventory management principle that Mario should implement. So here I've listed a few, but remember the question says apart from this particular one. So leave that out and we can pick any of the others. One could be, for instance, and remember I've just listed it, but you need to explain it if this is the task word that's used in the SAC or the exam, which is explain, okay, not just list it or state it. So one of them listed here is rotate the inventory. That means then when you're looking at the shelves and stacking up the shelves, always put the new inventory to the back of the shelves and push the old ones forward to encourage people to take that one first. This is especially important for perishable items like milk, yogurt, etc., and it reduces the chances of items getting spoiled. Or else you could talk about inventory mix, like focus on inventory items that sell well and slowly phase out the ones that do not sell that well. And the slow selling ones can be slowly moved to discounting. And that way, once you've got some discounts on it, it'll hopefully move faster. Or you keep up to date, set your minimum and maximum levels, or employ a strong marketing strategy. Any of those that you can explain well with a little bit of description and logic to it, that should work. Last but not the least, part J and K asks us to calculate the gross profit margin and net profit margin, as well as with part K, it says whether antique arts, which I've shortened here as AA, should be satisfied with the responses that we get for part J. And then it also gives us industry averages, and we need to justify that response. So for the calculation part, we've listed the formulas here. Gross profit margin is equal to gross profit divided by net sales into 100. The only thing that changes for the net profit margin is the numerator, which is the net profit instead of the gross profit. And I have listed I've input all the figures into the formula here, which gives us gross profit margin 60%. And remember, that's the same as the industry average given to us in the question. Okay, and net profit margin is 41.5%, which is higher than the margin given to us in the question, which is 30%. So the explanation in part K is that yes, antique arts should definitely be pleased with the ratios. With the first one, it's on par with the industry average, which is excellent because it suggests that you are achieving a sound markup and return on sales. The other one is also really pleasing because it's way higher than the industry average, indicating very strong expense control. So antique arts is getting, because it's 11.5% higher, so antique arts is getting 11.5 cents more out of every sales dollar towards their net profit than average in the industry. And that brings us to the end of this question. Thank you so much for watching and listening. Hopefully that helps with the application of these concepts, and stay tuned for more such videos coming out in the future for other topics.